up, everyone? Welcome back to Financial Education and Business. We're going to be covering Fubo and Kraken today, as these two are some of the small cap companies with great potential. I think it's worth taking a look at because they are definitely getting beat up for no reason. I think the overall market is just kind of taking them down just because. I think they're definitely way undervalued. They're doing. Sorry, I'm trying to fix something here. Fix the volume. All right. So, all right, let's get into it. Sorry, I had to do all that just to get set up here. So what I want to do here is just talk about Fubo and what the company does. And kind of talk about like the earnings that they reported and everything else. So they just reported Q3 earnings. So just looking at the summary of the Q3 that just came out, successful business combination. Though the completion of the merger with Hulu Plus Live TV is seen as a transformative milestone, positioning Fubo as one of the largest live TV streaming services in the United States with nearly 60 million subscribers. Strong subscription growth. Fubo reported 1.63 million paid subscribers in North America, making it the highest third quarter performance to date, with a notable 68% increase in net additions. Net additions accounting for those who decided to move on. Historically, here's the company's revenues, and this is nothing to laugh at. The company in 2021 was making about $156 million every quarter. And now this company, that's back in 2021, and 4 years later, this company is making 377. And from the way things are going, from the way that they're building up partnership, it seems like they're not going to stop growing. The current partnership is way more intense, and it actually means something just because who the partnership is with. And so they're going to really benefit. And that partnership is with Disney. So this Disney's partnership is going to really bring in way more new subscribers, just because Disney can just because Disney owns about like 70% of Fubo. All they have to say is just, hey, you have Disney Plus. How about, do you want also watch sports? Then just join Fubo at a discount. Just like the way they do, just the way Disney does that Disney Plus, Hulu, and ESPN Premium. ESPN at a subscription package, they can start throwing Fubo in there and get Fubo's name, out there, and maybe Fubo can be part of that premium package, only showing 6-7 different sports channels, maybe with ads, so they'll make ad money or ad revenue. So this is the interesting part about Fubo, is they have the potential to be just a phenomenal business. And we're gonna look at Fubo's Fubo events and presentations. So we're gonna look at Fubo's presentations and see if we can get the numbers that we are looking for. And also, we're going to react to this video, Fubo CEO on merger with Hulu Plus. We'll discuss that. Actually, I'm just going to go ahead and play that now so we can watch it.
After the company's latest earnings report, let's welcome in David Gidler, the co-founder CEO of Fubo. David, thank you so much for taking to be with us following your earnings report. Lots to talk about here, but if you wouldn't mind just starting with some of your key takeaways.
Yeah, look, it was a phenomenal quarter. But before I get into the quarter, it's probably important to note that we have combined Fubo with Disney's Hulu plus live TV streaming platform to form the 6th largest pay TV platform in the United States, and more importantly, the 2nd largest virtual pay TV platform in the United States.
So let's focus on that as the 2nd largest virtual platform here in the United States. How do you see that becoming a key growth driver for Fubo?
Yeah, well, as you know, Disney has solid resources. It's one of the largest media companies in the world. There are 4 key drivers that I think will really give us an opportunity to expand our business and to continue to grow. The first is obviously being able to market within the ESPN ecosystem, which has 50 to 100 million monthly active users in any given month, and that will allow us to really drive down subscriber acquisition costs. At the same time, we'll be able to experience programming efficiencies, driving down our programming costs, which is one of our largest cost line items, our subscriber-related expenses. And then there's the opportunity to collaborate on the advertising side, given their scale, which would allow us to really drive our CPM. So I see this as a massive opportunity for growth, and we're very excited about the unprecedented opportunities that we're about to collaborate on.
And David, how fast do you expect these synergies to materialize?
Yeah, well, as I said, I think there are a few areas where we could probably move really quickly. One of them is on the advertising front. I think, we think that Disney will be able to really drive growth. They'll be out in the market in the upfront talking about Fubo. We've also transitioned, as of yesterday, our advertising sales team to Disney. So that's an area where we think that we can probably drive some pretty solid results. And then, over time, of course, the programming efficiencies and being able to negotiate on behalf of, the 2nd largest virtual MVPD will create more competition in the market, better pricing for consumers, and at the same time allow us to have attractive economics to drive profitability.
And there's no argument that we made that there is not a very crowded streaming landscape right now. But now you have a tie-in with one of the biggest names in that landscape. As far as you look at how you're going to differentiate Fubo TV's value proposition, where do you plan to focus for investors?
Yeah, well, look, I think what we want to do is we want to drive profitable scale. This is an area where I think we've been focused on. Fubo standalone results that we shared yesterday were extremely strong. And when you, combine Hulu Live and the Disney ecosystem, it really amplifies these results. Unfortunately, we don't have our pro forma numbers yet. We anticipate that we'll have those in the coming months. And when we release them, people will be able to see the opportunity ahead. But it's a really unprecedented opportunity for a company like Fubo that has really differentiated itself focusing on sports. Now we have more shelf space, if you will, in this complicated streaming ecosystem. We have a much larger complete bundle in the form of Hulu Live, which is really focused more on entertainment. We have the somewhat skinnier bundle of Fubo and Fubo Sports, even skinnier. And also our standalone offerings through the Fubo Channel Store, which is similar to the Amazon Prime Channels product. So we have a plethora of products that we can offer consumers at different price points. And that has clearly started to work in the 3rd quarter. And we think that could continue into the 4th quarter.
So with you saying scaling profitability is important, what are some of the key milestones or metrics that you would like for Fubo to hit in the next 6 to 12 months to give investors confidence that that's happening?
Well, I think what you're already seeing is 2 consecutive quarters of adjusted EBITDA. we had our investor day in 2022. And Marley, I think you would agree that it's been a very complicated media ecosystem over the last 3 or 4 years. And for us to be able to achieve the results that we've achieved in 2025, as we said we would in 2022, not knowing many of the things that have happened, such as Netflix picking up sports rights. I think we've done a tremendous job being able to achieve strong results. But I think we'll be continuing to focus on the same things. It's really about subscriber growth. It's about expanding our gross margins and focusing on net income and free cash flow over the next 12 months. And at the same time, it's going to be revenue growth and some new areas that we'll be focused on, given Disney's scale globally, is our international business, which we've really been focused on developing a lot of the tech stack to be able to allow us to scale efficiently in markets that we think that there'll be pretty good opportunities.
And David, you mentioned that second straight quarter of EBITDA growth, but we also saw record subscriber growth here in North America.
Yeah.
As far as your model, where do you see your strongest leverage right now?
Yeah, well, look, I think from a cost perspective, if you just look quarter over quarter, year over year, we continue to improve all of our cost lines. But the real leverage is really our focus on sports and really ensuring that in a very fragmented environment, we can offer consumers a one-stop shop. We like to call that super aggregation, where we can provide consumers optionality and flexibility across different price points on the demand curve. So that's where we're focused. We want to make sure that we have as much shelf space as we can get and really sort of drive home the brands and the identity that we've created for some of these packages to ensure that we're top of mind as consumers make their choices. And as you know, there are two major structural shifts that are going on right now that are playing into this tailwind. The first, of course, is consumption habits are moving towards streaming services and virtual MVPDs. And on the other side, it's monetization. We're seeing monetization from television, move to more of the streaming services. And given all the data analytics and capabilities, there's a lot of interest in continuing to generate revenue in sort of, I would say, adjacent to subscription, revenue streams. So we're very excited about the future. I think this is a fresh look for us, and we're looking forward to next quarter.
A very exciting time, and like you said, you have navigated through some very interesting years in the media landscape. Certainly,
we have indeed.
I was here for them too. It has been interesting times.
Yep.
But David, thank you for taking the time to be with us on Trading 360 today to talk to us about Fubo's results and also your combination with Disney. That's David Gandler, the co-founder and CEO of Fubo.
Obviously, there are some questions about the valuation side of it, Dan's point, and it looks like one of the people.
That was awesome. Okay. So it seems like, I am so distracted today. Okay, so it looks like I am so distracted right now, but that's fine. That's fine. I'm about to be just a little bit distracted here. So we got that is, as you can see, the CEO is very aggressive. He doesn't seem like the kind of person, that can easily be pushed over. But he's saying that they're already the number six most subscribed to. I believe he said the number six most subscribed to channel, and so they're bringing more competition. But now they can eat away at that competition with price, and that's probably what they're gonna do next. And that is, I can see them easily doing that. So that's why you're seeing this. Like, because they're executing, the managers, their CEO is very aggressive, and that's why you're seeing that the company consistently beating EPS. They've been beating EPS since Q2 of 2022. Revenue, they've been beating revenue since Q3, even before that. So this isn't a company that is revenue numbers. Let me see. I see some red there. Revenue versus estimates. Let me see. Show estimates. Okay, there we go. So they beat revenue here. They beat revenue here. They did not beat revenue here, but then they came about even here. So Fubo missed revenue Q1 of 2025 about by 2.3% about. They missed again in 2024 Q4 by a little bit. And it looks like they have missed earnings like many times before, but EPS there has always been, earning per share has always been pretty impressive. Let's go into news because they just reported earnings. Okay, Fubo TV's sorry, I'm getting shy. Fubo TV seen as inexpensive best on US streaming trend analyst. So if we go here, let's look at this analyst. So Fubo TV beat expectations in its third quarter on solid subscription momentum and returned to a positive adjusted EBITDA. But the stock weakened as the price-sensitive growth pressured annual return per user, raised concerns going into 2026. Needham analyst, they maintained their buy rating on Fubo TV at $4.25, citing the company's earnings performance. Fubo TV posted revenue $337 million, which is down 2% from the year earlier, but 7% above Needham's estimate, and adjusted EBITDA at $6.9 million, compared to with $27.6 million loss in the prior year, while ahead of the firm's loss of $6.7 and estimate. The company completes its merger with Hulu Plus Live TV 3 days before the report. Despite the better-than-expected result, Fubo shares declined, pressured by negative revenue growth, lower ARPU, average revenue per user from this new skinny bundle tier, negative free cash flow, and lowered fiscal year estimate. Needham said it remains constructive on the stock, citing Disney's 70% ownership stake, improving scale with 6 million pro forma subscribers, lower cost constraints, lower constant costs, expanding bundling options, and integration on the advertising side of the business with Disney. Subscription growth and skinny bundle strategy. So the company launched a new $55 a month super skinny bundle on September 2nd to address the growing price sensitivity. With promotional pricing of about $45, despite the lower price, Fubo reported no cannibalization of existing customer at all. So they're lowering prices, but interesting, that doesn't mean the existing customers are jumping ship. They jump ship and go into the lower bundle, but they actually keep whatever bundle they currently have. It's pretty impressive. At the end of the quarter, North American paid subscribers reached 1.63 million, up 1.2 year over year, as churn fell by roughly 50%. That actually is really good numbers. Advertising at the end of the quarter, North American paid subscribers 1.63 million, up 1.2 year over year, as churn fell by roughly 50%, meaning like less people were unsubscribing, and trial conversions and net additions improved even with reduced market spend. So that is exactly what they said they're going to do. They're going to focus on reducing expenses. So which is really good, because if they can reduce expense, because right now ad is like eating up most of their money. At the end of the quarter, North American subscribers grew advertising revenue and international expansion. So analysts noted the Fubo's ad revenue fell 6% to 25.4 million, but still beat forecast expectation of 22%. North American ad declined 7%, while international ads surged 70%. About 75% came from programmatic sales, with direct deal earning about 50% of CPM premium. The ad business has been fully integrated into Disney. Yep. In France, Fubo plans to integrate its Molotov services into US platform and collaborate with Disney to tap into Disney Plus 100 million international subscribers. The company aims to build a global sports and live TV streaming platform. Its fast channel generated about $3 million, up 20% year over year from lineup of 200 channels. Wow. 200 channels making 3 million is crazy, and they still haven't really, expanded fully. It's fast. So that kind of a channel they have, I believe, in France. So strategic value, financial modeling. So Needham said Fubo's sports first position and skinny bundle model provide strong strategic value. Disney's major ownership reduces financial risk while maintaining upside. Do you think Disney's gonna let Fubo die? I mean, that's actually a really good point there. Like Fubo, like Disney does not want one of their companies to die off, especially if it's in the entertainment world, in the sports arena. So I could see that being a very important partnership for Disney, not just Fubo, also for Disney. So the Disney major ownership reduces financial risk while maintaining upside. The firm sees the company as a low cost way for investors to gain exposure to U.S. stream trends. Needham $4.25. Price forecast is based on the 10-year discount cash flow. 10-year discount cash flow is ridiculous. Using the 11.5 weighted WACC and assumed 10.9 annual EBITDA growth over the next decade. Ugh. Bro, why are they forecasting 10 years out? That's ridiculous. Fiscal year 2025, Needham projected revenue to be 1.57 billion with an earning per share of 40 cents and adjusted EBITDA of 30.4 million. Fiscal year 26 estimate were lowered to 1.56 billion revenue, earnings per share 15 cent loss, and 72.6 million in adjusted EBITDA. At the end of the day, so Fubo actually is one of those companies that saw a decent price movement despite the market being down significantly. So when we just look at it today, we'll see this bounce. So we saw that when the market opened, literally that it dumped, and then throughout the day, it's actually one of the stocks in my portfolio that was just above water, like swimming, 7% above everything else. And so that's why I think Fubo does have some kind of value here. So let's get into a little bit into Fubo, and let's look at Fubo's earnings. So let's look at their earnings here and see how they've been doing. Fubo. So if we look at their financial results, going back however many years here, we will see that Fubo okay. Let me continue here. All right. So let's look at what analysts are forecasting for Fubo. See where things are going. Okay. Do this. So four analysts here on stock analysis. They say Fubo TV stock. So it says that the four analysts that cover Fubo TV stock have consensus rating of a buy. So they're saying right now is underpriced by about 45%. So that's about down by $5. So price target of $5. It's like they're expecting to, they're hoping by the next 12 months it could be a $6.40 stock, average of $5.35, and the lowest is that $4.25. Right now, the stock is definitely below the average. It had a great day, but after hour it took a tumble here. If it's like this tomorrow, I am buying some, and I'm also gonna buy some Kraken and I'm gonna buy AMD if these stocks continue staying at these prices. Here it is. So here's how the rating used to be. It used to be 6 analysts on this stock. The number of analysts did drop down in November. The number of analysts dropped down even more. As you can see, the buys have stayed consistent, and the strong buys have stayed as 1, buy has stayed at 2 since June of 2025. Let's just do a quick financial analysis here, and let's look at them, just see like how quickly this company is growing, and let's look at it from a quarter-over-quarter perspective, because that might help how their short-term movement here. So as you can see, the revenue growth 33, 40, 20, 20, 20, about 20% revenue growth here, starting off 2024, but then going into these years here, Q4 24, Q1 of 25, Q2 of 25, and Q3 revenue kind of declined. So it's kind of interesting here. We see revenue start to decline in Q2 of 2024 and continue to decline from then on. Here, just like I got a phone call. Let me call. In the middle of finishing up okay, so let's go on here. So we're seeing that revenue kind of decline Q2 of 2024. So quarter 2, quarter 3, right? Quarter 4. So we're seeing this revenue decline. It'd be interesting to see why we're seeing that revenue decline. Maybe it's because of well, they're not customers are not being cannibalized. So I don't know what's going on here. I think this new partnership with Disney is gonna be pretty impressive here. So cost of goods sold, as you can see, it's been in the threes for the longest time. So that's about the average, about $300,000, $300 million in cost of goods sold. Gross profit, they're hitting decent numbers here. This company was losing money. Here, Q4 2020, I mean, that's way when COVID happened. That you skip that and you get into the real world here. Their gross profit is continuing to grow. I mean, they're slowly getting to it's obviously sporadic here, but like overall these numbers are getting bigger and bigger and bigger. The company's making more and more money. This growth wasn't that much at all. I think we see some kind of stagnation here, but also the revenue isn't really growing that much, right? Like the revenue actually, it's been going down, right? So we saw the revenue go down for the last 1, 2, 3, 4, almost a year, right? So since Q4, so not year, so since Q4 of 2024 to now, to this quarter, their operating revenue, these numbers have been just going down. 3, 4 from Q4, yeah. So these numbers are going down, and hopefully they'll pick it up. But the fact that they were able to eke, despite the revenue going down, they're able to eke a gross profit is kind of indicates the company's going in a better direction from a cost perspective. Selling general administration here, not too bad. It doesn't look like we're seeing anything that's in the red flag. It seems just like part of BAU. Research and development here doesn't look too bad. 17, 18, it looks consistent. Here is where we see kind of, some swings here. We're going from 75, 100, 111, 90 to $94 million that the company is spending here in their operating expense. I think maybe they need to find a way to reduce some of these specific costs, because it really is eating away with their operating income. This is a company that used to lose almost, significant 80 million, 112 million here, 93 million, 50 million. So as you notice here, the amount of money they're losing constantly goes lower and lower and lower. The company isn't losing as much money, which is really cool to see. Let's just go straight into net income here. Net income, the company losing 167 back in the day, Q4 2020, Q3 2021, they're 105 million. And then what do you see? Things are getting better, even though sporadic. We see 29, 49, 83, 70, 56, and then you see Q1 of 2025, they hit this huge marker of positive 188 net income, which can then flow to cash flows. They're issuing shares. I mean, they started at 68 in 2020. 5 years later, they have 343 million shares, which is a lot of shares outstanding there. Which maybe they could be doing stock-based compensation or something else out there. So cash, short-term investments here. Let's look at this annually. So cash, short-term investments, and current assets. So current assets and liabilities, they got a lot of liabilities, and they got a lot more liabilities, current liabilities, than they do assets, which from a balance sheet perspective, no bueno. Why is their current liabilities increasing, but then their assets are just not going anywhere? I wonder if this is consistent across most companies in the TV service platform. Total assets long-term assets and short-term asset combined. We're seeing better numbers, right? Better numbers here. They have more long-term assets versus long-term liabilities, which is a good sign. But from a short-term liability perspective, if the economy turns or something happens, it's going to be really bad for the company, because they're going to have to find a way to cover whatever is causing whatever is causing these liabilities. That's no bueno. I like seeing companies that have more assets. They got short-term debt. Accrued expenses seems to be something that's hitting them very significantly. These are expenses that the company is incurred, but they haven't paid, so they have to pay it out. And the unfortunate part is, it doesn't seem like slowing down. Here you got current unearned revenue. So subscription has been paid, and they have to fulfill the service, and then they can have those subscription money. They said current portion of lease. Okay, so they're gonna have to pay a lease. So that's how much they have paid. Yeah, but their balance sheet is okay. Like, I really don't like the short-term liability, which is definitely a problem. Let's look at their presentation. Hopefully they have a presentation that we can see. Webcast. I don't want to see the conference call. I want to see their presentation. Fubo investor presentation PDF. They should have one. Most companies have investor presentation PDF. Let's see. Let's go into X. This is the same website, Webcast. I don't want to see the video. Man, these are actually terrible. Quarterly results, SEC filing, quarterly resort. Let's do the quarterly results. I can't even say it. It says, I predict, this guy says how many followers he got. He got about 658 followers. I predict this month ago. This is from a Benzinga article today. Disney Plus signed up over 10 million subs on the very first day it opened its doors for business. The partnership is crazy. This says, let me zoom in. In France, Fubo plans to integrate its multi-TV services into US platform and collaborate, introducing them to 100 million Disney subscribers. We've already seen that. Let's see if there's anything actually worth gleaning. The Walt Disney Company owns 80% of ESPN. Wow. And then owns the remaining 20%. No, that's pretty impressive. So practically Walt Disney owns 80% of ESPN. What does that mean? Well, they can say, you know what, ESPN Sports is gonna have to go on Fubo, just because they have that voting leverage. So they can definitely drive anybody that's currently watching movies on ESPN or watching sports on ESPN. They can just go and start watching it on Fubo, and they're gonna just become Fubo's customers at the end of the day. I did not know that actually ESPN owned 80% of Disney owned 80% of Fubo. Of ESPN, but then they also own 70% of Fubo. So Disney is really becoming this like conglomerate that has a whole bunch of sports channels, and they can drive it to one company, and that company is Fubo. I mean, Fubo has, I think, one of the most sports channels compared to most companies. So if we look at how many sports channels does Fubo have, I mean, they have 200 plus. And the fact that they're also, going to the fact that they're going to like France, that's gonna be insane. So Fubo channels and plans, but then we can quickly look here. It says Fubo TV. Let me zoom in here. It says Fubo TV offers a wide range of channels, including 216 channels in the Pro plan, over 260 in the Elite plan. Additionally, there are various add-ons available, such as Entertainment Plus, Sports Lite, International Sports Plus, allowing users to customize their channel lineup according to their preference. Like, who is doing that? Like, right now, it just seems like Fubo knows exactly how to customize their products to their customers. And here it is, like Fubo really is taking advantage of this partnership with Disney. The recent news that rolled out, Fubo, as you can see right here on their website, they said, listen, we're gonna give you anybody that signs up discount, because YouTube yanked a lot of their Disney yanked a whole bunch of sports from YouTube, and now those are probably gonna go on Fubo. And those individuals that had YouTube Premium are gonna pay $45.99 and have way more channels. So you got, with this one, it looks like you got 22 channels: ABC, CBS, Fox News, ESPN, unlimited cloud DVR, and you can watch it up to 10 screens. And here are all the channels. The Pro version, 244. The Elite Sports, 320. Latino, 58 channels, so the Spanish language sports. And the fact that the World Cup is on its way, like, I think that's gonna bring them so many more customers. So you're telling me the World Cup is coming up, and then on top of that, they're going to be able to show the World Cup games in Spanish and English as well. And then on top of that, they have partnerships with Disney. Literally, this just came out. So the company is growing, and they're taking advantage of the current shift in the market and lowering their prices to get these customers off of YouTube and onto their platform. And you can see the add-ons are pretty impressive for a little bit more money. Well, a little bit is very personal, but for more money, you can add different channels and customize it to what you want and what you don't want. And so look at all these different options that you can add. No, that's pretty impressive. So you can compare Fubo TV versus YouTube, and then see which one is actually better. That's pretty cool comparison. They wouldn't have this here if they weren't confident that they're able to outprice YouTube. So say, okay, Fubo Pro Plan, 185 channels. YouTube has only 100. Simultaneous stream up to 10. YouTube, you can only watch 3 people. Only 3 people can watch simultaneously. Starting price $84.99. YouTube, $82.99. They need to update this because I think we just saw that these Pro plan is not $84.99, is it? The Pro plan, oh, it is. Okay, yeah, the Pro plan is not that price. Well, so it looks like it's $54.99 a month for the first month, and obviously goes back to the original price. But I think even if they extend this just a little bit longer, they're gonna get even more customers. But even with the full price, it's barely above. You get way more channels. You can watch it and stream games on multiple, way more screens versus what YouTube can. Anyways, I am very, very bullish on the company, as you can see. If you like Fubo, make sure you subscribe, because this is the kind of company. This is the kind of company that this is the kind of stuff I'm always covering, just trying to find the jewels, the best stocks to cover. But as you can see, I'm very bullish, and the products that they have is pretty impressive. So also, let's just look. Disney removing sports from YouTube, right? This just happened here, which is huge. Disney wants ABC back on but YouTube TV isn't up for it. I think this just went through. Why pull channels from TV? There you go. This is exactly what from YouTube TV on Tuesday. So this is going to be really what I was trying to show you, if it actually pulls it. Okay, here it is. So October 31st. Continue to the site. Stop. So Disney pulls channels from YouTube TV. What happens with the California media giant? So the fact that happened is pretty impressive. What does this mean? Well, this just means the channels are going to go to Fubo, and Fubo is going to get those YouTube customers. So YouTube, owned by California giant Google, announced on October 30th Disney had pulled its channels from YouTube TV platform after the company failed to reach a new contract agreement. Disney failed to reach a contract agreement with San Bruno YouTube system, blah 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 blah, on October 30th. But this is, at the end of the day, really good, because now YouTube is not going to be able to provide all the sports that they used to be able to, right? So with the World Cup, I keep saying this, but with the World Cup coming up and YouTube, Disney actually taking action, it's going to be very, very big, because those customers are going to go to Fubo. As you can see, here's the full list as per Google. So they pulled ABC, ACC, Disney Channel, Disney Junior, Disney XD, ESPN, ESPN News, ESPN N2NU, Freeform, FX, FXM, Net Geo. I don't know what all these are, but we know the Spanish plans, the ESPN Deportes, and soccer and football, like especially soccer, is very, very popular in the Spanish countries. So anyways, so this is pretty impressive that, Disney is kind of lining up with Fubo and actually taking action, and slowly they're probably going to grow. They're probably going to grow their customer. At the end of the day, actually, they own. Well, I guess you can say they almost own Fubo, because they own 70% of Fubo business, and they own 80% of ESPN. So here is November 3rd. Just yesterday, Fubo released their Q3 earnings, and it was pretty impressive. I think we were just looking at that here. So Fubo, most of the time, when it comes to earnings, they're able to beat earnings, but they struggle on EPS. There it is, EPS. So this company has been beating EPS since Q2 of 2022, and they haven't missed once. But when it comes to revenue, they have missed. We can see those numbers here. So they missed here in Q3 of 2024. They've also, there's a better way to look at this. Let me do it this way. Yeah. So Q2, so they missed. This is not how I want to see it. I'm trying to show this in a better format. Okay, yeah, I have to subscribe to this site because it's actually really useful. But as you can see, Fubo most of the time does beat estimates. Revenues, yes, they miss sometimes, but overall EPS is always on target. They literally missed EPS one time Q1 of 2022, and since then they haven't missed once. Are they going to stop all of a sudden, especially now with this new partnership with Disney? Probably not. So here is that where they reported their Q3 25, and they talk about it here in this note. These results pertain to Fubo's standalone operation prior to last week's combination of Fubo and the Walt Disney Company Hulu plus live TV business, which creates the sixth largest pay TV service in the US with nearly 6 million subscribers in North America. Strong Q3 performance set the stage for profitable scale as Fubo enters transformative next phase following combination of Disney, Hulu plus live TV. So a lot of this live TV partnership is definitely going to move to Hulu. So they maybe they'll show us the number. We can quickly look at those here. So Q1, Q2 net income. So they had a net income loss of 8 million. Looks like they lost 10 million extra $1 million here. Depreciation, amortization. I want to look at their financial results. Income statement. So let's start with their revenues and go from there. Live, what is this? A live webcast. General about Fubo TV. Fubo TV is a consumer-first live TV streaming company with a mission of delivering premium sports. So they keep bragging about this. They are now the sixth largest pay TV company in the US, and ranked among the America's fastest growing companies in 2025, fiscal year 2025. Fubo TV Inc. owns Hulu plus live TV, entertainment, Fubo Sports, Molotov, this is the French one, with market about Fubo, okay. So basis of presentation. In connection with this dissolution of Fubo Gaming Inc., termination of Fubo Sportsbook. Interesting. I did not know they had the Sportsbook. The assets and liabilities and operations, our former wagering reportable segment are presented as a discontinued operation in our consolidated financial statements. With respect to our continuing operation, we operate as a single reportable segment. Financial information represented in the related reflects Fubo's results on continuing operation basis, which excludes our former wagering report segment. So why did they, sports betting is getting huge. Why would they consider removing this? So why did Fubo remove the wagering sport Fubo gaming from their business? I mean, this would be good to know, like, why? Because gambling, not gambling, well, yeah, gambling, but like the whole idea of betting on games is huge business. So, strategic reasons for exiting the Fubo gaming. So, refocusing on core streaming business, Fubo is doubling down on its strength in live TV streaming, especially sports and entertainment. The sports book was a separate capital intensive venture that didn't fit the streamline. Financial optimization. The wagering segment was likely a drag on profitability. By discontinuing its Fubo could present a clearer financials and focus on improving metrics like adjusted EBITDA. I disagree. I think the wagering was not a bad idea, because let's say, like, they had a Fubo app where you can watch a game but also participate in betting who's gonna win. I don't know, they messed up there. Simplified operation. Removing the sportsbook allowed Fubo to operate as a single reporting segment, making it easier to manage and communicate performance investors. Regulatory and competitive challenges. The online sports betting space is crowded, expensive, and heavily regulated. I mean, right now it doesn't seem to be that way. Like, there's a whole bunch of companies that are out there. I mean, Kalshi is one. Robinhood does the same thing. So competing with giants like FanDuel or DraftKings requires deep pockets and long-term commitment. Or there could be, maybe in the future, there might be, because they're a sports team, there's an opportunity for some kind of partnerships. The move signals a pivot towards profitable scale and streamlined growth, especially now the Fubo has merged with Hulu Plus Live TV, forming one of the largest pay TV platforms in North America. Okay, I mean, I disagree. Maybe in the future they can't afford to do that right now, but in the future they'll be able to, they'll be able to just partner up with FanDuel or DraftKings and so on and so forth. Reconciliation, Fubo TV, reconciliation net income loss, reconciliation net income from continuing operations. They have about, so they lost extra 10 million. That's kind of crazy. Depreciation and amortization kind of stayed consistent quarter over quarter. Stock-based compensation did go up. They're issuing stock and diluting shareholders. Certain litigation and transaction expenses kind of went down. Other incomes and expenses here, looks like this number was insane. March Q1 of 2025. So Q1, Q2, Q3. Depreciation, income, net income really took a hit these two last quarters. Adjusted EBITDA better. I mean, they went from a loss to positive 20 to now 6.7 million. Reconciliation net income from continued operation non-GAAP. Net income from continuing operation, September year over year, so definitely much better this year. Depreciation amortization, there's more this year. Impairments and of other assets, so losses. Stock-based compensation, that wasn't as much year over year. Certain litigations definitely went up here year over year. Income tax prevention, that doesn't really hit them much. Reconciliation net income attributed to common shareholders. Yeah, now these earning call download, these earning documents are just terrible, to be honest. All right, that is it. That is all I'm gonna cover for now. I was gonna cover Kraken, but I am getting tired. It's at 11:30. But thanks for joining me. Make sure if you're here, you subscribe, because I'm always dropping these types of videos. I'm gonna be going live almost every day, at least for a little bit. But that's all for the day. Have a great rest of your night. Peace. I'll cover the rest of it